Hello, everybody. Thanks for joining me today. It's kind of a cloudy day here in New York. We're expecting some rain that's coming across. I guess it's been going from west to east. So we're going to get some sprinkles. But all in all, we've had a really nice summer. In the evenings, it's almost been fall-like. Well, it's felt more like October than it did August. But I hope wherever you are, your weather's been your weather's been good. There's always some analogy between the weather and the stock market. Today certainly feels like it's not so sunny and kind of stormy. Felt that way on Friday. I put out a QuickTakes on last week's action, and it certainly looked as though some of the steam had come out of the rally that we've seen since June 16th. I think it's to a large extent because there probably was a lot of short covering. I mean, this market's been brutal on both sides for quite some time there, from January 3rd to June 16th. It was real tough to be long stocks, so it really was punished the bulls. And then from June 16th until just recently, it must have been very painful to be short. And I think we've seen a lot of short covering, a lot of FOMO, a lot of people who felt like they might have missed the rally, kind of jumping in. As you remember, it started out pretty strongly with a 6% increase, like in a heartbeat. It was after that that I concluded that we probably had seen the low on June 16th. So a significant part of the rally had already occurred before everyone started to question whether June 16th might have been the low. Now we're asking ourselves, where do we go from here? I think I'm not a technician, but I respect technical work. A lot of people pay attention to it, so it does have an impact on the market. And what I'm seeing is that we got up to the 200-day moving average late last week and couldn't take it out. So from that perspective, that's somewhat unsettling. But I do things from a fundamental basis, and from a fundamental basis, there are a few events here that are coming up that are not exactly conducive to a continuation of this rally, which probably has created an overbought situation. So we've got Powell talking at the Jackson Hole conference on Friday, and he's likely to more or less say what he said at the press conference. But this time we'll see how the market interprets it. Powell has a tendency to say things that can be interpreted as bullish or bearish, and people tend to kind of cherry pick what they want to hear. I think that happened with the press conference where everybody heard that Powell say that 2.25% to 2.5% is neutral for the Fed funds rate. That's where the Fed funds rate was after the FOMC meeting, which he gave the presser after. And the conclusion that a lot of people seem to have come to is, therefore, if we're already at neutral, then a couple more rate hikes and we're in restrictive territory, and that could be the end of the monetary policy tightening cycle. So that apparently got the market somewhat excited. But a lot of that news is in the market, so it's hard to see that Powell's going to say anything much different. And if he doesn't say much different, the market may focus on his more hawkish stance, and he's got to take a hawkish stance on inflation, kind of saying that he's happy to see that we've made some progress in some areas on inflation, and there's expectations that that might continue. But on the other hand, there are areas which are going to remain persistently inflationary, such as rent. I don't know if he's going to be that specific about it, but he might be. Then, of course, on September 1st, we're going to get the manufacturing PMI, Purchasing Managers Index. Why is that important? Well, it tends to be a really good indicator for the growth rate on a year-over-year basis in S&P 500 revenues, S&P 500 earnings. And so it's an extremely important number. And we've been doing a lot of work, others have as well, but I think we've been doing better work than others on showing the importance of the regional surveys. There's 5 of them that we've been following. I think we're going to actually start to include the Chicago survey, which tends to be manufacturing and non-manufacturing, whereas the other surveys tend to be more or less manufacturing. Manufacturing is the most cyclical side of the economy, and that's why it's such a cyclical indicator. drives the cyclical variable of revenues and earnings when you take the growth rate. But the New York and Philly surveys came out last week, and they were weak, suggesting that the manufacturing PMI may actually fall below 50. That doesn't necessarily mean that that's signaling a slam dunk recession. I think you have to get down to about 48 for the MPMI to have a history of signaling a recession. But we do have leading economic indicators, which peaked in February. Data now is available through June, and that shows that certainly is signaling a recession down the road. Not the coincident indicators, which in June jumped to an all-time record high, but it's the leading indicators that we want to focus on. And the stock market, the S&P 500, is one of the components of leading indicators. We'll get into a second why I think that whatever recession we're going to have is going to be mild and more of the nature of rolling. But let me just finish up the September litany of issues. And then inflation comes out on September 13th. The CPI inflation rate comes out on September 13th. And everybody's going to be nervous about it. That's all I can tell you. I think, well, I can tell you more. I think we're going to see durable goods inflation continue to moderate. The way gasoline prices are going, some of the meat prices, according to the newspapers about what meat prices are doing, it looks as though we may continue to have moderation in July's CPI as we did in June. So we can have 2 months in a row now, kind of confirming that the CPI inflation rate peaked around April and May of this year, and it's in fact moderating. But again, offsetting that undoubtedly will be some of the factors such as rent. Other areas of services that have been troublesome, like airfares, I think those are moderating. Hotels and lodging, I think that's moderating. So I think the big problem is going to continue to be rent for the rest of the year, maybe into next year. So that's what we're facing up ahead here in September. Oh, by the way, September, as we all know, tends to be the worst month of the year. I mean, it's not always a bad month. We've had good months, we've had bad months in September, but of the bad months, it's right up there as the worst. So I guess that'll make people nervous as well. Let's go to the videotape here. Let's go to the share screen. And by the way, last time some of you were not able to see the charts, and I thought I screwed something up, but I'm happy to say that I did not. Zoom apparently had some issues because a lot of you reported that you actually were seeing the charts and a few people were not. So I don't know what was going on with Zoom. I think right after my conference call, Zoom stock took a dive. So I don't know if that had anything to do with it, but I haven't been watching Zoom, so I can't tell you if it's back or not. But let's discuss this idea of a rolling recession. This is the most widely anticipated recession of all times, which from a contrarian perspective either suggests that it's just not going to happen, or that if it does happen, it's going to be mild, and it could be so mild that it never happens officially. Officially, you want to look at the index of coincident economic indicators. That's this blue line here. It's got 4 components. And I think if you look at the history of it, you'll see, as I've shown you before, that the peaks and the troughs in the index of coincident economic indicators just happens to coincide with the peaks and the troughs of recessions. Look, economists look at a whole bunch of data, but I think it's pretty clear that the dating committee of the National Bureau of Economic Research at the end of the day mostly is concluding whether we're in a recession or not based on whether there's a significant peak in the CEI and a significant trough. And obviously that's going to take a few months past the peaks and past the troughs to make that decision. So they can take their sweet time about it while the rest of us have this huge debate of whether we're going into a recession imminently or we're in a recession and how severe it is. But there's certainly no recession in the coincident economic indicators. There is a recession in the leading economic indicators, and I'm hesitant to fight it, so I won't. I'll tell you, yeah, that's probably, we might have seen that recession in the first half of the year. Everything seems to happen faster and more compressed, kind of on speed and steroid business cycle. So maybe that's what leading indicators are showing us, that we had a technical recession in the first half of the year. I have pointed out that that recession could be easily revised away to show that the economy had a growth recession, no growth. So let's just kind of stick with my idea that that's a growth recession or a rolling recession, that it goes from different sectors to other sectors without hitting everybody at the same time. So we never get sort of that cruncher of a recession. Well, we certainly seem to have a manufacturing recession. The regional survey data, this is the 2 Fed districts. We have it through August, and here's the 3 Fed districts we have through July. So there's really enough information in the 2 Fed districts to come to a conclusion about what the 5 are probably going to show. By the way, it's interesting that the Philly and New York Fed are actually, they're very cyclical, but they're not as volatile as the other 3. It's some work we're doing on trying to figure out which ones of the surveys are best as leading indicators of the MPMI. But anyway, you look at it, the 3 districts turned negative back in July. The August turned further negative. And so they tend to be weighted to manufacturing, and it does suggest that the manufacturing sector is slowing down, which is consistent with the view that consumers are pivoting away from goods and buying services. On the other hand, autos is an important good that people purchase, and there's a lot of pent-up demand there. And we're actually seeing some increase in production going on in the auto industry. So there's the idea of a rolling recession. Some goods consumers aren't buying. There's too much inventories at some of the retailers, but few goods, particularly some big items like autos, are still in high demand. Appliances, furniture, things that are housing related clearly are weakening. So here's, it's not a perfectly strong correlation, but clearly there's some correlation between the 2 Fed districts and the year-over-year percent change in industrial production and manufacturing, which, by the way, is still positive, as you can see, at 3.1%, but it's down from like 13% peak. But again, look at how, sorry to be, I hope you're not getting seasick here with me moving the chart up and down. That's what happens when you've got a touchy-feely monitor here. You can touch it and feel it. So here you go. So as you can see, we've had a pretty compressed cycle here compared to the past, and a lot of the pandemic has just created all kinds of messy situations with the data and with our lives, of course, importantly. Figure 5, housing is in a recession. Housing-related retail sales are depressed, so there's nothing really new there. I guess what we'll be watching for is big drops in home prices, but unlike 2008, we don't have as many derivatives tied to it. Consumers have better credit scores, so we're not likely to see a whole bunch of delinquencies. Here's the affordability index. That doesn't look very happy for the housing industry. But again, as I said, look at motor vehicles. In recessions in the past, autos have usually participated in the recession, especially ones that were caused by tightening monetary policy, because not only is housing demand sensitive to interest rates, but so is purchasing cars. And yet you can see that production has been so depressed because of the supply side issues that as they become less troublesome, the auto industry is able to produce cars and sell them pretty quickly, very quickly. And look at this inventory to sales ratio. It's really mind-boggling. So the pandemic, as I said, is everything's topsy-turvy. Capital spending, CEO Outlook Roundtable survey shows that it's cyclically turning down. It's still high in the second quarter, and it is highly correlated with the growth rate in inflation-adjusted capital spending, which is down to 3.5%. It could turn negative, but I'm thinking maybe not. I think companies realize that they've got some serious chronic labor shortages. They've got to spend on technology and capital equipment to increase the productivity of workers. So I think that'll be an important offset, technology capital spending especially. When you look at the 5 regional surveys, we have data through July, through July on our current and future components of the regional capital spending. And again, they kind of look like the CEO survey, like capital spending, kind of turning over. Question is, you know, we've had kind of turning overs before. something like this. A lot of that was energy related, and then kind of a bounce back without a recession in this case. In this case, obviously, we had a significant recession led by capital spending and consumers. Construction spending is an area where the recession rolls through the housing market. So that's the blue line, all-time record high in construction put in place. Then we would expect that home improvements, which is what this is, might start to slow down. On the other hand, if people can't move, they may decide to improve the look of their house. So that may continue to do well. I think Home Depot and Lowe's are examples of companies that do well when consumers continue to spend. As I've said before, when consumers are happy, they spend money. When they're depressed, they sometimes spend more money, especially if they can't sell their house and can't buy a house and have to continue renting or staying where they are. And so they furnish things, they improve things. But what we're looking for is the non-residential is basically structures, but the public sector has been kind of weak. And now you would think with all the spending programs that Biden's come up with, that we're likely to see that strengthen. I guess that it could be a labor restraint on the government. They may want to spend all this money, but they may find that it's actually pretty hard to do it because of the limited supply of labor. Then, of course, speaking of the government, industrial production of defense and space equipment, all-time record high in June, July. It's edged down just a little bit in July. But given what's going on in Ukraine, our cold, warming war with China, there's only one direction this is likely to go, and that's higher. So again, September is the cruelest month, not April. T.S. Eliot had a poem said that April is the cruelest month. It's actually September, and on average, as you can see, back to 1928, it tends to be the biggest downer of all the others. I know people think October is, but October is actually pretty good. So I kind of viewed September setting up buying opportunities for the rest of the year and into the following year. Now here's the ugliest chart of them all. I've saved it for last because I guess I'm trying to be an optimist at heart, but also need to be a realist. And a lot of people have been bringing this to my attention. It's a chart we've shown from time to time. And now to really scare people, if you've been scared by the chart, blue and the red, look at the blue dot, which shows what the Fed intends to do with quantitative tightening. They intend to reduce the balance sheet starting September at a faster pace than they have been through June and September. And that faster pace is the dotted line, $95 billion per month. The Wall Street Journal has an interesting article today pointing out that while the Fed may be cutting back its support to the mortgage-backed securities in the Treasury market, we may very well see that the deficit itself is narrowing. You know, it's good to be king as long as they don't behead you. If you're king, you can have enough inflation to rev up your revenues without having to raise taxes. The inflation will do that. If inflation gets totally out of control, then they behead you or you lose an election. So we'll see how that plays out. But the reality is the king has created a lot of inflation. And as a result, revenues have been absolutely booming at the same time that outlays have simmered down after the pandemic. But again, they never seem to be able to stop spending. But a lot of those spending numbers are over 10 years. Divided by 10, it's not as bad as the big numbers, but it's bad enough. But here, people look at this and tell me these are highly correlated. All I see is two lines that are going up. I can give you any two lines that are going up and tell you that they're highly correlated. So I'm not convinced that they're kind of locked, tied at the hip, attached at the hip, I guess is the expression. And I do agree with the journal that you have to look at total supply and demand when you put this in the right context. And I've been also adding, I'm surprised the journal didn't really mention it, that TNIC, there is no alternative country. A lot of global investors want to invest in the United States. That's evident in the dollar. Why are they buying dollars? Well, a lot of that, according to data through June, the TIX data shows that they're buying dollars to buy bonds in the U.S. I think you're also going to see that they're going to be buying equities, though they do tend to be contrary indicators. And the data through June shows they've actually been selling equities into this bear market. So again, they tend to buy at the top and sell at the bottom. With all due respect to my friends overseas, you folks are real smart, but on average, you can actually use that data as a contrary indicator. So it's a scary, spooky kind of chart. Halloween is coming, September is coming, October is coming, but we don't think that we're going to retest the 3666 low. Sentiment was just god awful, and we don't expect that sentiment's going to get that bad again. And I think there has been already a lot of capitulation by investors, if not simply outright exhaustion. So that kind of wraps it up. Oh yeah, this is another chart of why I like the Fed business district stuff. You can see that the year-over-year percent change in the S&P 500 is pretty well correlated with the district surveys. So let's go do some Q&A. Let me wet my whistle. And I got two questions, so we got some time here if anybody else wants to join in. This is Dilk. What are your thoughts on the energy crisis in Europe, and how do you see the impact on the U.S. economy and markets? Yeah, I really should have mentioned that. We don't have to wait until September. We're already getting news that the Russians are continuing to shut off the gas supply to Europe. So the Europeans really have to scramble to find what they can, which is pretty hard to do on a short-term basis. And also they need to ration their use of gas. So rationing inevitably means cutting down on some production, having thermostats lower. I mean, it's not going to be it's going to be a tough situation in Europe. So I think the odds increasingly are that Europe is going into recession as we get into the winter months. And that's going to have an impact on China, because China exports a lot to Europe, as do we. So it'll have an impact on us. So I think we are looking. If we started out looking at the global economy before we kind of right away focus on the U.S., the global economy is in for a slowdown, if not an outright recession. But to the extent that global investors want some safe harbor, I think the U.S. becomes a safe harbor, and that kind of inflow helps to keep the dollar strong, which helps on the inflation side. Not so great on the earnings comparison sides from some of the multinational companies. But I'm not convinced that a recession in Europe causes a recession in the United States. I know historically recessions have been synchronized booms, synchronized busts. So certainly it's hard to see the U.S. economy doing remarkably well in that environment, even if TNEC means money is coming to the United States. But again, I'm in the rolling recession camp at this point, in the U.S., of course. Doug, inflation break-evens have collapsed lately and continue to do so. The one-year break-even has declined from 6% to 2.6% now. Any thoughts? The bond market's been kind of a funny kind of rigged market for quite some time, because the Fed was in there buying all these treasuries. Now the Fed is going the other way and starting to sell off its maturing treasuries and mortgage-backed securities. I certainly know that one of the reasons that the housing market's in a recession is because of the anticipation of QT, quantitative tightening, and some comments made by some Fed officials that they shouldn't even really be in the mortgage business. They shouldn't be Feddy the way Fannie and Freddie are. And so we had this huge widening of the mortgage spread above the 10-year bond yield, which was also going up. And that, of course, has pushed the housing market into a recession. I'll do some more work here on the, oh, look at that. That's That's little Oscar there. That's my mother-in-law's staying with us, and little Oscar's out walking about. He's being quiet today. See, I shouldn't jinx it. He might start barking. Uh, by the way, my wife ran across a story that in New York City they're kidnapping expensive-looking dogs, and so we warned her about Oscar over here because he's expensive. So we live in crazy times. Let's see, Michael, in stocks, value or growth going forward, cyclical or defensive? Both. I don't, I mean, we've seen both working for short periods of time and a lot of rotation around these things. I still kind of, as a long-term investors, thinking kind of the way Buffett thinks, I'd say technology and financials and energy makes sense as overweight. So that's sort of a barbell of value and growth. We saw how quickly technology could get back what was lost in the bear market. Quite a bit was gained, but then again, if now we're going to favor the bears for a little while, tech will be the underperformer. And then, as we saw last week, utilities, consumer staples, healthcare, stuff that's not exposed to a strong dollar, stuff that's not exposed to a lot of exposure overseas, outperform things like the cyclicals. So, in a rolling recession scenario, I think that might be actually the way it plays out. I mean, I try to tell you what I think is going to happen, and I think that's what's going to happen. Take a couple more here. Mike, how was your piece in the FT received? Is the idea the Fed has already done enough tightening very non-consensual? Yeah, I think it is non-consensus. I haven't heard too many people talking about the notion that when you factor in QT, factor in the strong dollar, that each one of them, I don't have an econometric model. I think the Fed has hesitated to I'm sure they've done some econometric work on it and have some in-house estimates of what QT is worth in terms of Fed funds rate hike, and the same thing for a strong dollar, but they're not sharing it with us. I think there was one time when Powell said that we have no experience with QT. We actually had a little bit of experience, but it didn't last very long. It's kind of unsettling that the Fed has committed itself to this QT program, where there it goes, where the notion is that we don't really know how it's going to play out. So naturally, the market is going to be very concerned about it. Let's see, what else do we have? So we've got Silberman. I'm just back from vacation and catching up on news, and it seems everyone I talk to is dealing with COVID among family members, and people are sicker now. Are you worried that additional COVID surges could derail the rosy outlook? That's honestly news to me. I mean, I torture myself and watch the evening news just to see what everybody's being subjected to, and it's always very trivial and light news. It's, what's the bad thing that happened today? Then let's turn to the bad weather, and then commercials. But I haven't heard anything about COVID. They're pretty quick about COVID, but I'll have another look around. We put out something called What I Am Reading, and so we are looking at the headlines pretty thoroughly. So I hope you guys all get better, and I hope all of you folks have a good week. And thanks again for joining me today. I always appreciate your interest in our research. Have a good week.